Hi, my name is Stuart and welcome to the Investopoly podcast. My goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Keep the questions coming in if you have any sort of questions or even any feedback. Love to receive it. You can send it to me at questions@investopoly.com.au. And also just a quick reminder, I've mentioned it a couple of times, but there's a 97-point checklist that you can download. The link's in the show notes. It covers things like choosing investment grade properties. You can kind of tick off the considerations, retirement planning, property tax deductions, all those sorts of things. It's some checklists that I built many years ago. I put them all together, reviewed them, and hopefully that sort of helps you, consider your own situation and find risks and opportunities that you can address. So let's get into today's topic. And the question is, will the Australian share market ever outperform or will continue to underperform, depending on how you want to sort of frame it? I mean, essentially the observation is, particularly over the last 10 years, is the Australian share market has underperformed relative to global and particularly US share markets. And let's take the sort of recent correction, do you want to call it that, or share market drop at the beginning of this month, really between the 1st and the 5th of April, where the Australian share market and also the US share market fell 6%. So the US share market fell 6%, we followed, of course. Now, since then, the Australian share market has recovered by 2.6%, whereas the US share market has recovered by 5%. So not only did we, and look, there's a lot of commentary around what caused that correction. There's some commentary around Japanese carry trades, so people borrowing in Japanese yen, zero interest rates, and investing in other geographical markets. The concern around recession. My personal view is I don't think it's really anything. There's a lot of emotional or irrational behavior sometimes in the short term in markets, and these things can happen. But the point is, if you're an Australian share investor, you've got to be a little bit annoyed because the fact is that nothing really was fundamentally wrong at the beginning of the month to drive the market 6% lower. So it's kind of fake news, if you like, if I can use that term. Now, the US market is almost fully bounced back, but, the Australian market's still underperforming. And it's kind of annoying as Australian investors because if there's nothing fundamentally that's changed, why should we underperform? But even if you take a broader lens, I'm just using that as a really recent example, but as a broader trend, we've underperformed. And what I wanted to do is look at that a bit closer, look at some longer term evidence and, pose that question. Will we ever outperform? Will Australia have its opportunity to generate better returns than, say, the US or international markets? So as I said, it's really easy to get sucked into most recent performance and draw sometimes long-term conclusions from, just that very short recent data. So therefore, it's really important, particularly as we're making long-term investment decisions, to take a long-term viewpoint. So certainly last couple of years, even the last decade, the Australian market's underperformed, but really we need to have a look at how has it performed, say, over the last 3 or 4 decades. And I have a chart on the blog and the website which charts the relative performance between the ASX 300 and the MSCI World Index, which is the most commonly used world stock index that includes all developed countries. And so I've looked at the last decade and then going back decades beyond that as well, so going back 4 decades. And I can tell you over the most recent decade, international shares have delivered over 12%, Australian market under 8%. So it's quite a considerable differential. But the previous decade to that, Australia was 9.5%, global was just under 6%. The decade even before that, so we're talking from 94 to 03, we've got 8.5% for Australia and 6.5% for global. So there you go. The last 10 years, been massive outperformance by international index, but the previous 2 decades before that, the Australian market did better. And the oldest decade that I looked at, which was 84 to 93, there was a small disparity there, 15% versus 19%. Probably not that small really, but we're talking about pretty good returns in any case. So, I mean, if you invested $100 in the Australian market at the beginning of 2013, because 2013 was really the point where the international index started to take off and the Australian index did not. So if you invest $100 in 2013, it'd be worth about $255 by the end of 2023. So I haven't brought those numbers up into today, but it's going to be around about the same amount. In comparison, if you put that $100 into international markets, it'd be worth $465. So 4.6 times your return versus 2.5 times the return. We can see that what we might consider a relatively small differential, 8% versus 12%, can over time, compounding, have a huge impact. So I think we safely draw the conclusion that absolutely the sort of longer term evidence, 10-year returns, demonstrate that the international index has certainly outperformed the Australian index, and that was reflected in the most recent example at the beginning of this month. So then it's important to think about, okay, what has contributed towards this outperformance? And then we can then perhaps form a view, will it persist? And it's very clear, it's really obvious, in fact, in the numbers that information technology as a sector has been the biggest driver in the international index, and particularly information technology in the US. Information technology as a sector now makes up about 25% of the global index. Now, if you go back 10 years ago, it was about 13%. So it's grown from 13 to 25% of the globe. It's absolutely dominating the global index. But in fact, it's worse than that. The concentration risk is even more concerning. So the so-called Magnificent Seven stocks, which include Apple, Amazon, Google, Facebook, Microsoft, Nvidia, and Tesla. They're the 7 sort of technology stocks, if you like, that make up this Magnificent Seven. They now account, just those 7 stocks, for 21% of the global index. Remember that included in this global index is not only the US market, but all of Europe, including the UK, and Japan. That's really, most of the index, if you like. So even despite that, just those 7 stocks make up 21%. And now they're all approaching 1/3 of the US index as well. So huge concentration risk. And their market caps have surged massively, so in terms of their overall valuation. And it's really important to recognize and call out that technology has absolutely, undeniably been a major economic contributor, as well as, contribute towards, society and information flows and community and connection, all these sorts of things absolutely have produced a massive change over the last decade. But the question we have to ask as investors is, to what extent is that future growth and future profitability of AI and the transformation and all that sort of story behind it, to what extent is that already reflected in current prices? Because if all the upside is reflected in current prices, the only way an investor can enjoy a return by investing in those stocks is if those stocks actually exceed the already very, very lofty expectations. And when you look at the average forward PE ratio of these stocks, it ranges between 30 and 40 times earnings. Now, when you look at the market's long-term PE ratio, it's sort of 17, 18, 19 times. So they're trading at twice the level. Now, that means, we've got to acknowledge, firstly, that acknowledges or suggests that earnings are sustainable. That's already a risk. But let's say current earnings are sustainable. Even though they're sustainable, we're paying double the price for these stocks. So yes, it's fair to pay a higher price because the expectations are that there's going to be higher growth in the future. But to what extent is that already factored into current prices? Now, it's really tempting to assume that these giant companies will dominate stock indexes for the long term. And it's actually, I think, probably really difficult for us to think about, under what circumstances would Facebook, for example, not be around anymore, or Microsoft or Apple or Amazon. We just can't see those companies necessarily at this stage going anywhere or losing their market power. But history shows that actually the top 10 global businesses by value change quite considerably from decade to decade. So firstly, the evidence suggests that, in fact, of those Magnificent Seven, it's very unlikely that all those 7 stocks will be in the top 10 in the next decade, in the coming decade. And also, I'm reminded, for those that are old enough to listen to this podcast, that remember the tech bubble back in the early 2000s, Cisco Systems at that point was worth $500 billion. That's its market cap. And people were writing that Cisco Systems would be the first $1 trillion company. Well, today, its valuation is 180 billion. So less than half of what it was back in 2000. Even though at that stage in 2000, people were talking about Cisco systems like they're talking about Nvidia today or some of those other major tech companies. So we need to be really careful, I think. And I think the answer is that it's very unlikely that these Magnificent Seven companies will make the same contribution to index growth over the next 10 years than what they've contributed over the last 10 years. Not impossible, however, just very unlikely. And that's kind of where the risk is. So what can we do to think about then what will the future hold for us? If they don't make that contribution, how's it all going to sort of play out for us? Well, I turn to a global research firm called Research Affiliates. It publishes a sort of asset allocation model that uses, evidence-based, peer-reviewed methodologies to sort of forecast future stock market returns. And these models consider the factors like dividend yield, profit growth, and valuation multiple changes over time to project investment returns. It uses things like the CAPE ratio and those sorts of tools. Now, they aren't perfect predictors, of course, of future returns. That's impossible. It's like predicting the weather. But these models have shown a very strong correlation with actual returns. So they're not the perfect predictor, but the most reliable predictor that we have. And there's a sort of a 70-80% correlation with future returns. So again, it's not a perfect predictor, but again, it's pretty strong. And to my mind, as an evidence-based investor, it's one of the bits of evidence that we would use in order to sort of construct a portfolio. So anyway, I consulted that model to sort of work out over the next 10 years, what are the returns likely to be? And I've included a chart in the blog on the website, but I'll just run through that now. So the best performing market is likely to be Japan. They've predicted 8.2% return. Now, they actually expressed the return in a range. I've chosen the amount that represents the 50% probability, so that's really the most likely, but it can be in a range, of course. Australia and emerging markets are pretty similar, 7.8, 7.9%. The global index excluding the US, 7.6. Europe, 7.2. US large cap stocks, only 2%. And I think that's reflecting the fact that, maybe the growth is already factored into the share prices. So the global index, including the US, then is predicted to only produce 3.4%. Now, I don't think I would necessarily hang my hat on these exact numbers. What I'm most interested in is relative performance. So, for example, Japan and Australia are expected to be the top performers, and US large cap are expected to produce maybe a quarter of their return over the next 10 years. That's the thing to kind of walk away with from this analysis, not so much, okay, I'm going to get 8% compounding from the Australian market over the next 10 years. So as I said, these models uses dividend yield plus growth, so the growth in profit, plus valuation multiple adjustment. They're the three components to calculate the expected future returns. So then let's delve a little bit deeper into the Australian forecast of 7.9% over the next 10 years. And the 7.9% is broken down to 3.9% for dividend yield, plus 2.5% of inflation, plus 2% of real growth, less 0.5% for a valuation adjustment. So that means that there's a slight drag due to valuation adjustment on future returns. And to my mind, what it suggests is that the Australian market might be slightly overvalued, but there's not a huge amount in it. We can probably just assume kind of fair value. Now, if you have a look at the dividend yield for Australian investors, the dividend yield in the calculation is 3.9%. But for Australian investors, it's probably going to be higher than that because of imputation. So the current dividend yield that you'll get off ASX 200 ETF is around 3.5%, 3.6%. That's a net yield, excluding imputation credits. And so you gross that up to work out what your pre-tax income is. It's more likely around 4.7%, 4.8%. So we can probably add an extra percent as Australian investors to that forecast. So instead of 7.9, let's call it 8.9 or 9%. 5%, if you like, in terms of forecast. So I would make that adjustment because I don't think the model deals with imputation. Obviously, it's really built for global investors. But the point is, if you're going to get 4.7, 4.8% in terms of income return, so more than 50% of your total return over the next 10 years is going to come to you in income, to my mind, that reduces an investment's risk because it means that you've got less reliance on this future growth, which is kind of the hard number to put your finger on in order to meet your investment goals. So if you're after 9% and you're getting 5% income, well, at least you've already banked a significant proportion of the return. And sure, you need 4% growth, but it's better than investing in a market that gives you much lower income. Now, I just wanted to mention while I'm here, Japan, because Japan's forecast to deliver the highest return, 8.2%. Although, again, if you factor in imputation credits, Australia is ahead of that. But I just wanted to talk about it. My personal view with Japan is I'm a bit concerned that they're almost addicted to zero interest rates. And a big part of the projected 8.2% return is a currency fluctuation with the Aussie dollar. So yen versus Aussie dollar, the model is assuming that it's going to make a 2% contribution. So that probably means, I would imagine, expecting the Australian dollar to appreciate in value and maybe the yen to depreciate in value relative to the Australian dollar. So foreign currencies are a really difficult thing to predict, and I'm more interested really in what is the actual growth coming out of that share market rather than the changes in fluctuations in foreign currency. So don't look at that chart and then think, oh, gee, I'm going to put all my money into the Japanese market. I mean, you can do that. I think that would be not a wise thing to do because of that foreign exchange situation. I'm happy to be equal weight Japanese, so I want some exposure, but I don't think I'm going to overweight my exposure to the Japanese market. And of course, this podcast was really about the Aussie market because as Australians, we have, whether it be in super or portfolios outside super, we have a significant exposure in the Australian market. And we've got to know that different geographical markets will perform differently over decade periods. And that's why, as long-term investors, we need to have the discipline to stick with that long-term asset allocation, even though some parts will underperform over that time. So look, certainly the Australian market has underperformed over the last decade. Let's acknowledge that. I think it's unlikely that it will underperform over the next decade. In fact, it's more likely that it's going to turn around. But I wouldn't take that to say disregard international markets because we've got to remember or remind ourselves that the Australian market only makes up around about 2% of global developed markets, and it's heavily weighted towards miners and banks. So there's a significant amount of sectors that we don't really get exposure to as Australians, and it would be really silly to ignore those international markets, ignore 98% of the rest of the world, if you like, from an investment perspective. So I still think we should have international investments. We probably want to consider how the large cap US stocks might impact future returns and accommodate that in terms of our asset allocation, how we invest, but also have the discipline to stick with the Aussie investments, knowing that firstly, we're going to bank a higher income, and secondly, it's very likely, looking at those long-term forecasts, that the returns differential will reverse over the coming decade. Okay, so let's see if I can squeeze in some listener questions, some answers to some listener questions, more importantly. So let's jump into some. So John asks, what is the best way to manage all your investments, shares, properties, super, etc.? John, I'm going to assume you mean sort of tracking taxation and overall performance, overall wealth and those sorts of things. The question's a bit vague, John, but I'm going to make that assumption. Look, if I think about the way that we manage that for clients, the first thing is that I would like to track overall wealth, overall personal wealth, both from an overall wealth perspective, but also from an investment asset perspective. So kind of ignoring lifestyle assets like the family home, because ultimately we want a pool of investment assets to fund retirement. And I wouldn't overcomplicate it. I think the best way to do that is just a simple spreadsheet that you might update every 6 months or certainly every year that lists all your assets and liabilities, exclude lifestyle things like home contents and cars and, those sorts of assets that really don't have a value, a resale value. Of course, you can put your home in there and holiday house and those sorts of things, but, we're really talking about investment properties, shares, super balances, cash, those sorts of key assets that we're going to use to really fund retirement. And I would just construct a simple spreadsheet like that and then be able to sort of track it. What gets measured gets done is a saying. You can't manage what you don't measure. There's a lot of sayings around measurement, and even just the act of doing that and putting that together will invite you to really think about, whether you're moving in the right direction, whether you're comfortable with your financial position, and if not, what changes you might need to make. Tracking returns is really important. I mean, superannuation's pretty easy. You'll get a statement at the end of each financial year which will tell you what the returns have been. And as you know, I produce a blog and podcast on that every year around the end of July, early August when returns come out. So that one should be a relatively easy one. If you've got a share portfolio, you want to track the performance. The problem if you are just using an online share broker is the only measurement you can make is what you currently hold. You might have bought and sold stocks over the years, which has contributed to your overall investment performance. But unless you track that, unless you keep quite a detailed spreadsheet, if you like, it's going to be really difficult to calculate that performance. And so you might have lost money, but your current positions in terms of actual trades, but your current open positions might be in profit. And then that might suggest to you, actually, I'm doing quite well, but actually not, because you've lost money in previous years. So it is really important, if you do have a share portfolio, to consider performance. Now, if you're a buy and hold share investor, particularly in ETFs, that's going to be easy to do. You can just map out performance from the ETF providers on their websites. Will publish 1, 2, 3, 5, 10-year performance. So that's going to be easy to work out then, how's my portfolio performed? And there might be some timing differences there if you've invested during the year, but that'll give you a broad idea. If you're a long-term investor, that's all you need to do. If you're trading stocks, buying and selling, or you're investing in direct shares, you might want to have a different approach. And a platform like NetWealth, for example, would be good for those sorts of share traders, because that will not only help you with tax reporting, cost-based recording, all those sorts of things for CGT, but most importantly, it will calculate historic returns. And so then you can benchmark yourself and say, okay, well, if my portfolio has delivered 10%, I'm pretty happy with that because I couldn't have got 10% elsewhere. But tracking share portfolios is important. And then let's talk about property. So how do you track performance of property? It can be a real challenge. And the problem is that, well, firstly, property is not traded every day. So you've got to strike a valuation. Valuations can be quite subjective. If you're over optimistic around your valuations, you're going to skew your returns and maybe make your investments look better than what they are. Also, I find that people tend to be, have an emotional element with property as well. And so sometimes that leans towards overinflating its value and thinking that it's doing better than it is. But also, it doesn't necessarily make sense to go and update the valuation on a property every 6 months. I mean, many years ago, we used to do this for clients. Every year, we'd try and work out what is the value of the property. But you've really got to then think about, has the market moved? And what I'm sort of saying is that work that we used to do, we don't do it anymore. I'll explain what we do, but because it didn't really provide us any meaningful information. So, for example, if you had a property in Melbourne, I probably wouldn't be doing any analysis on it at this stage, because the Melbourne market's kind of being a bit all over the place. It's a bit in the doldrums. You're probably not going to expect as a long-term investor that your properties have delivered much in the way of capital growth returns. So it's kind of not important. Whereas if I had a property in Perth, for example, or Brisbane, we know those markets have been performing quite strongly. I would want to make sure that my property is keeping pace with that growth. So I'd probably look at revaluing that property or getting an estimate of, how is it tracking from a growth perspective. But if it was in Melbourne, I probably wouldn't bother. And that's kind of the approach that we've taken, is we've been considering, well, how has that geographical market performed? And based on that answer, is it worthwhile looking at growth or calculating growth at this stage? And then the final element is net rental yield. And this one's a really good one to look at, because, the gross rental yield, I'm renting it for $550 a week, is really in our face, easy to measure. But what I'm most interested in is what the net rental yield is, and looking at that on a portfolio level. So I would use your tax return in order to do that. You can add up all the expenses, all the income you've received, all the expenses, and then work out your net rental yield. And from there, you can work out, well, if it's really low, then you really do need a lot of capital growth. How confident are you're going to get that capital growth? If the net rental yield is quite high, well, that kind of reduces the investment's risk to some degree, because you need less growth to justify it. Having said all that, of course, the reason we invest in property is mainly for capital growth. But that's the way I would approach in terms of managing the performance of investments. And John, I hope that really answers your question. Okay, so the next question is from Leonard, and the question's really around the argument for home ownership versus rent investing. And Leonard writes, I think you will say the most important concern will be to focus on the quality of the asset, regardless of whether it's a home or investment, but leaving all things equal and only considering financial outcomes without the influence of lifestyle factors, would you be better off financially rent investing versus owning your home? It's a great question, Leonard. Maybe it's one that I need to revisit. I actually found a blog that I wrote in December 2005 on this subject. That's nearly 20 years ago. No wonder I feel tired. I can't believe I've been writing all this rubbish for this long. It really comes down to, you're right, Leonard, quality of the asset and then relative difference in rental income received versus rental expense paid. So if you can afford to buy a really good quality asset, so a good asset in a quality area, it's more likely that it'll be most economical for you to rent that property out and go and rent in a cheaper location or a cheaper type of property to get the negative gearing. However, it would be best if you could live in that property first so that you could claim it as your main residence, then move out, then go and rent somewhere that's relatively cheap, pick up the negative gearing benefit, but you still for 6 years get to claim it as your principal place of residence and not pay capital gains tax. So then you've got an investment property with negative gearing and no capital gains tax in a good quality location. That's kind of the holy grail. Putting lifestyle considerations aside, as you've said, Leonard, that would be the best way to do that. But the thing you've got to realize, or at least from my experience over the last 20 years, at some point, virtually everyone will want to own their own home with no debt. And so when we're developing a long-term investment strategy, we need to keep that in the back of our mind, or probably keep it in the front of our mind, that that's going to be a goal. Now, I'll leave room for the possibility that there's 1%, probably not more, of people that over the course of their entire life, they won't want to live in a home that they own. So I'm not saying everyone, but I would say most people. And I can say over the last 22 years I've been running this business, I haven't seen one exception to that. So again, I'm leaving room for the possibility there is such a person, but I haven't seen it. So if we know we're going to want to own our home in the future at some point, we have to recognize two things. Firstly, we need after-tax dollars to pay for that home. That means I need to sell some investments, pay capital gains tax, and then use the net amount after tax to be able to buy that property. The second thing is it's probably, depending on location, it's probably going to cost me a lot more if I buy that property in 20 years' time than what it will cost today. Also knowing then that I might have to sell more investments because I need more money after tax to buy the same property in 20 years than what I would need today. So I think that's a really important consideration as well. And I know you said keep lifestyle elements out of it, but that's the reality, is that if we don't buy a home today, we've got to recognize that it could in the future, and we want to change our mind in the future, it could leave a massive dent in our asset base if we buy it in 20 years' time. The final thing I would say is that for many clients, their home has been one of their best investments, particularly from an after-tax return perspective. And that's because of the nil capital gains tax element. And I know you said ignore lifestyle factors, but lifestyle factors are pretty important too in the strategy. Now, I think the only caveat to what I just said is that if you need to live and want to live in an area that makes terrible investment and you can rent in that location for an economical amount, you don't have to overpay. Well, in that situation, I think rent investing could work out better. So I want to live in the middle of nowhere. I can rent really cheaply in the middle of nowhere. Why would I buy a house there? Because there's not going to be any capital growth and it's probably going to be cheaper over the long run for me to rent. In that situation, rent investing probably makes sense. But the reality is lots of people want to live in capital cities for lots of different reasons, and that would be the exception, not the rule. Great question, Leonard, and thanks for asking it. Look, I'm mindful of time. I like to keep these podcasts down around about half an hour or less. So let's leave it there. Just a reminder, if you have any questions, send them to me at questions@investopoly.com.au. I'm answering all of them. I'm getting through them all, but I'm receiving new ones. So it might take me a couple of weeks to get to you, but I certainly promise to do so. And just a reminder, that checklist, if you're interested in that, there's a link in the show notes. Okay, until next week, bye for now.